I used to think trading was a game of logic. The more I learned, practiced, and understood the technical aspects, the more money I believed I would make. I studied all the candlestick patterns, read hundreds of indicators, drew thousands of supply and demand zones, but my account was still in the red. Every trade seemed right, but in reality, they were wrong, very wrong. Each time I cut my losses, I comforted myself by saying I lacked patience. But deep down, I knew something was fundamentally wrong. Then I met my mentor. He didn't teach with slides or live screen sessions, nor did he shout for us to enter trades. He didn't even teach me technical analysis. The only thing he taught me was how to see what others couldn't see. I still vividly remember one rainy evening. I brought my laptop, opened the raw USD chart, and said, "Master, I think the market will continue to fall because it broke the bottom." He didn't look at the chart but asked, "Who will have the courage to keep selling when everyone else has already sold out?" I couldn't answer. That was when I finally understood I didn't really know what I was doing. I was trading based on the crowd's expectations. People like me didn't know anything deeper. Then he told me about 6 steps he used before entering a trade. Steps he called seeing the blind spots in the market's eyes. He said, "If you want to survive long term, don't try to guess where the market will go. Learn to recognize when the whole world believes in something that is wrong." That day, I stopped seeing the market as just charts and started seeing it as a collective flow of emotions. And today, if you still feel lost like I once did, if you're still holding onto technically correct trades that are wrong in reality, if you've ever wondered why you get all the entries right, but still lose, then maybe you need to know the 6 steps my mentor passed on to me as a vital legacy in this chaotic Forex world. It's not theory, not a course, but a path that only those who truly want to survive will have the patience to walk. Right now, I will share with you the very first step, also the step my mentor always takes before even looking at the charts. But before we begin, I want to say a few words to those who have been here, following me all this time. When I started this channel, I didn't intend to talk much about strategy, because the strategy I use isn't easy to accept or understand, especially through a few short podcast videos like this. But then I realized that so many Vietnamese traders are losing direction in this very market. And I thought, if just one sentence from my videos can help you see more clearly, then I should share it. If even a small part can help you go further or think a little differently, that alone makes me happy. I know a 20-minute video can't fully convey everything I want to say about this strategy. So if there's any part you find confusing or want to explore deeper, just comment below. I will read, collect your questions, and explain more clearly in future videos. We will walk this journey together slowly, steadily, and gradually. You will start to see the market with different eyes. My mentor doesn't live in the financial district, doesn't wear a suit, and doesn't sit in a cold room with 3 screens. He lives in the suburbs, where no one cares if the Dow Jones goes up or what the Fed announces today. He raises fish and grows plants. Yet his trading account is bigger than those talking heads on Bloomberg. He never needs to say much and has never taught trading to anyone. I came to him not to learn, but to observe how a man can remain calm amidst the wildest financial storms. I remember the first time I followed him. It wasn't to learn, but just to watch. He told me, no need to learn anything. Just sit quietly and watch the market. Listen to your own thoughts. I didn't understand. I thought trading was about analysis, forecasting, and risk measurement. But he never guessed. He just sat silently, opening the price board without a word. Once, I secretly looked at his screen. No indicators, no volume, no RSI, No Fibonacci, just a blank chart. His eyes looked deeply as if he was having a conversation with the market. I asked, "Master, what do you see in this blank chart?" He smiled and said, "I'm not looking at the chart, I'm watching how the market lies." I was silent, and from that day on, I never looked at charts the same way again. I began learning to feel the market. My mentor often said something that I still remember clearly: the strongest in the market isn't the smartest, but the last one standing to place the next trade. You don't need to be right all the time, nor trade every day. He waits, and when the opportunity comes, he strikes like lightning, fast and decisive, never repeating mistakes. Once I asked, "Master, do we trade with the trend or catch the reversal?" He just answered, "Neither. Just know when the crowd is blind." I'm not telling you this to idolize anyone. I want you to understand that beneath the surface of trading, there is a hidden layer of people who don't make noise or boast, but survive every storm. And my mentor is one of them. He doesn't need fame. He only needs to know his account is still alive today. And if the market reverses tomorrow, he still has the strength to move forward. Before I started this video series, I called him not to ask for tips, but to ask permission. I knew he didn't like to appear publicly or be called a trading guru. He hates noise and always said the market only pays those who keep secrets. That call happened on a quiet noon. I was sitting in a small cafe with a gentle breeze outside. I picked up the phone, still a little nervous, when he answered. His voice was calm and steady as usual. I told him I wanted to share a series of videos about his trading method, not everything, just what I had absorbed. He was silent for a few seconds, then chuckled softly and said, "Just don't say my name." Then he laughed a familiar laugh, full of unspoken meaning. I knew he agreed with that silent approval. I can now share what I believe might save someone who's about to fall in this market. I don't promise you'll make money after watching these videos. I only hope you will lose less, be less confused, and feel less alone on this journey. Because I know so many are losing not because they're bad, but because no one has shown them how to see the market as a living entity with emotions, beliefs, and mistakes. And if what I'm about to share helps you understand even a little, then that call and his gentle laugh were not in vain. Right now, I will tell you the first of the 6 steps. My mentor passed on the first step that opens the door and lays the foundation for every decision after. If you're ready, let's move forward together. The first step my mentor taught isn't a setup or a trend-following pattern. It's a very simple question. Where is the money flowing? He said, if you don't know where the money is going, you're standing in a desert without a compass. Don't enter a trade if you don't know who's winning and who's panicking. Step 1 is to observe the real interest rates and measure confidence in the strength of a currency. I thought he constantly read the news, but no, he watches how the wealthy react to news, not the news itself. Every morning, he visits tradingeconomics.com, checks the 10-year government bond yields of major countries: USA, Japan, Germany, UK. If US bond yields are steadily rising, he says the market trusts the USD. If yields drop while economic data looks good, he shakes his head and smiles. People with money don't trust the data. They're worried. He doesn't use any indicators, he only watches and feels the real interest rates, meaning interest rates minus inflation expectations. That's what big money cares about. While beginners only focus on yesterday's candle, step 2 is comparing correlations between major currency pairs. One of the first things he showed me was never to look at just one pair. When I asked whether he thought USD would go up or down, he opened USDJPY, GBP/USD, orders, USDCHF, AUDJPY, and the US dollar index. if the USD is weak across all fronts. There's no need to guess, the money has already pulled out. He doesn't draw anything or use indicators, just watches and senses which way the market leans. Step 3 is observing price reactions after news. It's not about the news itself, but how price reacts to it. Once, after a very strong US non-farm payroll report, the USD surged. I wanted to buy USD immediately. He sat quietly for 10 minutes, then said, "If after 15 minutes the price doesn't continue or starts to reverse, it means the crowd has finished buying." Sure enough, about 30 minutes later, the USD sharply reversed. He looked at me and said, "The crowd believed, but big money did not." Step 4 is the tools he uses. I was curious because he didn't use indicators. So what does he use? Just for main sites, tradingeconomics.com to check interest rates, bonds, and macro data, investing.com for news calendars, dxforexore.com to watch price reactions after major news, and market.com/currencies to monitor overall currency pairs. But he reminded me these websites are just tools. The most important things are your eyes and intuition. Step 5 is a mindset foundation, not to look at charts before understanding money flow. Every morning, he sits down without opening a chart, just looking at money flows and asking, where is the money leaving? Who is panicking? What contradictions exist between data and price behavior? And then he says something I still remember. A winning trade isn't about where you place your stop loss, it's about understanding what emotions are driving the market. I asked when to enter a trade. He replied, when big money exposes its weakness. Right now, I will tell you step to how my mentor finds the flaws in the crowd's expectations. Like a hunter, not chasing the noise, but tracking hidden footprints behind the wind. After watching money flow, step 2 is to find cracks in the crowd's belief. He calls it finding the cracks in the wall of belief. The market doesn't operate on truth, it operates on what the crowd believes is true. When good news comes out, they buy. When bad news comes, they sell because they think they're reacting rationally. But he warned that it's not the event that moves the market, but the expectations before the event that cause the surge. For example, good news, but price doesn't rise. Once, the USDJPY came out lower than expected, a positive for the USD. The crowd thought inflation was cooling, so the Fed would be less hawkish, stocks would rise, and the USD would fall. USDJPY immediately dropped nearly 60 pips. I looked at him, and he said nothing. But 15 minutes later, the price reversed, and USDJPY surged even stronger than during the initial drop. He sighed and said, CPI was good, yet the USD didn't fall deeply. That means the sellers had entered before the news, and now there's no one left to sell. They're trapped. Example 2. Bad news, but the price still rises. Another time. European GDP came out very weak. Eurist fell slightly right after the news, but less than 30 minutes later, it started to rebound sharply. I didn't understand. He just smiled. He said, the market prices in news before it happens. When the event doesn't push the price further, it means the expectation has run out of steam. He called that the market betraying expectations. Whenever he saw price moving against the popular expectation, he started to focus intensely. It didn't matter whether the news was good or bad, he only wanted to know what the price was saying about the crowd. When price reacted opposite to the crowd's belief, he never traded immediately. He observes. He waits for the second reaction when the crowd realizes they are being played. How he identifies the point of being played. First, compare the price reaction with the news content. Second, observe the volume fluctuations during the Asian and European sessions, where the market is more exposed. Third, note the price zones. where the market reacts strongly but fails to continue. If the price reacts strongly but doesn't move far, that is a point where expectations are rejected. This is the core mindset of step 2. The market always creates a story to attract belief. But the winner is the one who knows when that story is no longer believed. The crowd doesn't lose because they believed wrongly. They lose because they refuse to accept that they believed wrongly. And he points at a candlestick. When you see a strong spike, then the price reverses. Don't just call it a false breakout. Ask yourself, who believed, who is trapped, and how will they exit? I once asked, so when is the right time? He answered, when the market begins to betray expectations, but the crowd still hasn't realized they are wrong. That's the smallest but strongest window to observe. Right after this, I will tell you step 4, how my teacher entered the first trade. A light touch to probe the reaction is not to win immediately, but to clearly see the opponent's hand. If you ever lost because you entered too early, this step will make you rethink your entire trading approach. Do you want to hear more music after seeing where the money flows? And when my teacher sensed the smell of lost faith, he never entered a big position immediately. Never. He always starts with an action whose true value I later learned. Enter a small trade just to probe. I once asked why not enter strongly once he was sure. He was silent for a moment, then said, if you don't know the market's reaction to a small cut, don't rush to draw your sword and strike all out. Probing is not to win, but to listen. A light trade, a very small part of the account. No expectation. To win big, no take profit, no tight stop loss, just a tap on the market, a sound. A shake to see the reaction. What does he observe after entering a small trade? 3 things. 1. Can the market swallow the order? If the price reverses to fast, maybe he was wrong. He withdraws immediately. 2. Does the volume fluctuation change? If the price moves slowly, he holds on. But if there is a scent of blood, he becomes cautious. 3. Does the opposing side resist? If the price slows and then turns back towards his entry, that signals an unstable balance of belief. A real example, AUD ones. After the good US GDP news, the market rushed to buy USD. AUD fell sharply, nearly 70 pips. He did not enter immediately. He waited until AUD formed a small consolidation zone, then entered a very light buy order. I asked, teacher, are you bottom fishing? He smiled. No. We're just asking the market how it reacts if we push lightly. The price moved sideways, then nudged up. He said nothing. Minutes later, he entered a stronger position 3 times larger. The mindset behind a light trade is not to make money, but to confirm whether his feeling is right or wrong. He doesn't trade like gambling. Every trade is a question sent to the market. If the answer is clear, he proceeds. If it's vague, he withdraws. I once saw him close a losing trade after just 10 minutes. No thinking, no regrets. Just one sentence. The market refused to converse. The lesson I learned: we often want to win the day, want to be right immediately, want to look at charts and instantly know to go long or short. But my teacher treats the market like a living being. No rush, no forcing, just a light knock on the door. If the market opens, he steps in. If not, he turns away. No problem. Next, I will tell you step 4. When my teacher sees the right sign, he no longer stays gentle. He attacks with full force, like a decisive sword strike. No hesitation, no splitting. If you've wondered when to enter strongly, step 4 is the answer. No course will teach you music. My teacher is very patient. He can observe for a whole week without entering a trade. But once the market shows weakness and the probing trade is confirmed, he's no longer gentle. He calls this the strike when the enemy is off balance. When does he attack full force? 1. When the probing trade is profitable and the market doesn't resist. 2. When price reactions confirm the crowd is panicking. 3. When big money starts flooding in on his side. 4. When time shows no one dares to go against the trend anymore. It's not when the price is right to enter strong, but when you see others are wrong but don't know it yet, then attack. A real example, USDJPY. Another time, after US inflation news, the market thought Fed would raise rates further. USD surged across pairs. Everyone shouted buy USD. I sat still. 30 minutes later, USDJPY started weakening. He had entered a small trade earlier when USDJPY broke down to a strong support zone. With no buying force pushing up, he entered a second trade 5 times larger than the first. I asked if he was sure. He said no, but he knew the buyers were exhausted and they would panic stop out. Hours later, USDJPY fell nearly 100 pips, attacking but not gambling. I once thought he was all in, but no. He splits the account into layers of trades. The first is probing, the next confirmation. The attack trade is when the market begins collapsing its own belief. You don't need to enter big to win. You only need to enter big at the right moment. The signal he waits for to enter strong. Price breaks the balance zone of belief. Where before, both sides thought there was no significant pullback. The weak side is exhausted. Good news comes, but price cannot hold. Expectations officially collapse. The market starts holding against the trend, which is the most fragile time. I saw him make a profit with a single trade in a month, enough for 6 months without trading. He says going big is not to win big, but to exploit the moment the crowd flees. When they panic, he stays calm. When they roar, he strikes. My teacher doesn't trade many trades, but each trade is like a heavy iron door closing. No hesitation, no turning back. Right after this, I will tell you step 5, the one no one wants to talk about, cutting losses. You saw me cut losses ruthlessly, and he taught me not because he's tough, but because he knows to survive you must know how to lose properly. Music. I thought my teacher always won, but no. He lost many times, but what impressed me was how he lost. He wasn't angry, didn't try to hold on or recover. The strong one is not the one who never loses, but the one who knows how to lose without losing everything. My teacher cuts losses very quickly, without hesitation. I saw him exit a trade after just 10 minutes, even with a good setup, supportive news, and the market not yet fully reversed. I asked, why not wait a bit more? The price isn't wrong yet, he answered. Being right or wrong doesn't matter as much as the market not agreeing with you. If the reaction isn't as expected, then you're wrong. That's all. He set stop loss, but usually cuts before it's hit because he doesn't wait for the market to prove him wrong. He just needs one thing. The market doesn't respond to him. If price doesn't move as he wants after a while, he pulls out. Don't wait for the market to hit you hard before bleeding. I once saw him lose 3 trades consecutively, each losing a very small part of the account. No one noticed, no one panicked or was affected. Then on the 4th trade, he attacked full force and recovered all losses plus triple profit. The core mindset: loss is the cost to stay in the game. No one enters the casino without paying for a seat. The loss is the ticket price. If you want to stay, you must pay. I asked if he ever regretted cutting losses. He smiled. Yes, but only for a minute. Regretting not cutting losses can cost you a month. How he decides to cut if price moves against him, but hasn't hit stop, and the market is silent. He cuts if good news comes, but price doesn't rise. He cuts if the money flow clearly reverses, even if the trade has slight profit. He cuts. We don't hold a position just because we entered it. We only hold if the market still supports it. Why does he never hold on to losing trades? Someone holding a losing trade is someone emotionally wanting to be right. But the market doesn't pay emotions. He said, you can be wrong, but don't let that mistake push you out of the game. To win big, you have to stay in for the next round. And I always remember what he warned me. If you don't learn to cut losses early, one day the market will cut you in half. Right now, I'll tell you about step 6, which is also the last step. Increase your position size when the opportunity is confirmed. How my teacher scaled up winning trades without turning it into greed. Because he always said, when you're right, don't just stand there and smile. Give it one final push. When I was young, I thought if I was in profit, just hold still, do nothing. But my teacher was different. When he saw the market reacting as expected, when the opposing side started to flee, he didn't stand by. He increased his position. If you've entered the right burning house, don't just bring one bucket of water. Bring the whole hose, not blindly adding trades. He didn't hold winning trades the way others suggest. He calculated carefully. Each new trade was only added when the market allowed. When did he add trades? 1. When price breaks a key zone with no rebound dot tool. When volume rises, but there is no resistance. 3. When big money clearly stands with your side. Adding trades not to get rich fast, but to maximize advantage in a rare moment. A real example, GBP, USD, after a series of bad news, the pound plunged. He had a small sell position before the USDJPY broke the 3-week low and price never recovered. He added a second trade, then a slight rise to the broken zone. He waited and entered a third trade. I asked, teacher, aren't you afraid the market will reverse? He smiled. When the enemy has lost morale and you hesitate, you don't deserve to be a general. He had rules for adding trades. Never add if the first trade hasn't clearly made profit. Never add if the market hasn't pushed the opposing side to the breaking point. Each new trade needs its own breathing room. Don't stack stop losses on top of each other. Increasing position size is not to show off, but to squeeze out the last drop of opportunity before it disappears. I asked him if he ever added wrong. He nodded yes, but if wrong, he cut faster than the first trade. His final mindset, big opportunities in the market don't come every day. But if you're patient enough to wait, when it comes, don't miss it out of fear. And I learned something not found in books. Skilled traders aren't those who never make mistakes, but those who know when to play small and when to play big. So you have just heard the 6 trading steps my teacher passed down. From watching the money flow to striking and knowing when to retreat. It's not just a strategy, but a way of life, a way to navigate the market like an awakened person. Music I used to think scaling up was reckless, like an all and full of risk. But my teacher showed me a different perspective. Adding trades isn't always greed. If you don't know how to exploit the moment the market submits, you miss the one thing that can compensate for many stop losses. Real opportunities don't come often. In a year, maybe only a few truly clear moments. In a week, maybe only one time the crowd loses faith. In a day, maybe only a few minutes when all resistance disappears. And if at that moment you hold a profitable trade, the question is no longer whether to hold on, but whether you are wasting a rare profit chance. That only happens a few times a year. My teacher often said there's nothing wrong with going big. The mistake is going big before you know you're right. That's the difference. He only adds when all signs confirm. The crowd no longer believes the old direction. The opposing side is forced to sell. Price reacts exactly as expected on each retest, and especially, no counter momentum appears at the critical moment. I asked him, what if you're wrong? He answered, cut your losses. But if you're right, it must be big enough to be called a killing blow. Scaling up is not to get rich fast, but to avoid regret. You can survive the market with discipline, but you only rise by seizing the right moment and scaling up at the right time. That's how he amplifies being right, not chasing illusionary wealth. One last rule he gave me: if you're not ready to lose your current profits, never think about adding trades, because each add is a bet on your judgment, and you must accept if it reverses. And finally, he emphasized, good traders aren't those who win many trades, but those who win big at the right time, knowing when to be patient and when to be decisive. If you've come this far with me, what you just heard is not just some content, but the full practical strategy my teacher spent his life discovering, and reserved for the few who truly want to go far. No flashiness, no show, just 6 simple steps you can write on a small piece of paper, but deep enough to keep you alive in a market where most die from their own emotions. The right strategy is not to win every trade, but to know when to stand still, when to act, and when to let go. That's what my teacher taught me, and now I pass it to you just as he gave it to me once. Never repeated. If you have any questions about any of these 6 steps or want deeper analysis, leave a comment below. I will read, gather your thoughts, and clarify in future videos, so you not only understand, but truly live by each step in this strategy. This is the end of the 3-part method sharing, but not the end of the journey, because the market never stops testing, and each of us can become a wiser version of ourselves if we remain humble enough to listen once more. If you're still here, I know you're not like the crowd, and I believe you have what it takes to go far when everything around starts to get chaotic. We'll meet again in the next video, and I'll say only this: that video will be well worth your wait. See you soon in a new chapter, quieter, deeper, and perhaps the real turning point on your journey.